All right, so you've obviously registered for the support classes for investment management, the derivatives module, the INV3701. This is the support material that you have for the course. You've got the full, I think it's 7 weeks or 7 sets of notes, and then we'll obviously look at assignment and past papers. Have they changed the assignments, or is that also...
Assignment 1 is multiple choice?
Yeah, but it's still written as per normal. They give you the separate tutorial letter. So this tutorial letter that you've given me.
Yes.
Okay. Yes. So this is still as per the normal. It's just the exam they've changed.
Exam and assignment
2.
2 and 3.
Yeah, because assignment 2 is normally written.
Yeah, this is now an online thing.
All right. So it's all online. Okay. So prior semesters it used to be multiple choice and a written submission for the one. This was semester 2. Okay, that's assignment 2. This is online. All right, there's also assignment 3 as well.
Yeah.
Okay, and the examination. All right, so they've changed it slightly. We can actually, I don't know if you want to maybe complete this together, maybe over one of the weeks. We can log on and we can check it, and we can go through it then, and we can discuss and do calculations. Right, it's up to you.
I'd like to, because I think we've got that assignment, I think it's going to be correct, we've got like 10 submissions we can do.
Okay, so that's great.
Go on.
So we can do it once in class, and you can do it again later if you need to. All right, because I know, yeah, we for Boston we hosted CAS last semester, and that was purely online. So students came in and we did all the course content and assignments online. So it was a bit different, but it works. So we've got access to internet, so if we need to that we can. But I see assignment 1 is still the same in terms of structure. Okay, so that's a slight variation compared to prior semesters, right? But the material's all the same. I had a look at the study guide, but I just didn't look at the tutorial letter, but we now have. Okay. All right, so just a little bit about Creativa Solutions. Obviously, the mission statement is to create value, okay, by helping to find solutions. And those are some of the values that I've created for this particular business. Okay, so CS education is what you've obviously looked at in terms of the support classes and tutor services. You've looked at the weekly options. So we've got the live interactive classes, which is weekly, right? For this module, it's 10 weeks. For your FIN, this is 7 weeks, and for your FIN, it's 10 weeks. All right, so the customized support material is what you've got. So you've got the material for the semester. We will go through worked examples and questions, okay, and minimum 2 past papers that we'll cover from start to finish. Okay, I do need you to assist me with that in terms of getting the newer past papers. I've got older, but it's always better to do newer past papers if you do have those available. You mentioned that the exam is online, so I don't know if they'll still print past papers, hard copy past papers. In the past we had hard copy past papers like all the other modules that we could actually use. I know, you probably remember Michelle. She was the only other student that has done this particular course. I know Robert's interested. He hasn't obviously registered, but it was so far it's yourself. Michelle, she passed the distinction for it. Yourself, number 2, and then Robert was interested, but nothing confirmed yet. Yeah. So I do need to know if UNISA will give you printed solutions to the actual, not printed solutions, printed answers to the printed questions for the past paper that they have online. Right, because I think when Michelle wrote, she also wrote on, I think she also did it online. Okay. Right, so, but obviously I think she was the first student that did it online, but before her, it was all past papers. So we had like a set of past papers that we could have worked through, and obviously the online was what she did. Okay, if I remember correctly. I think she did mention, it was a while back, Michelle has left for about 2-3 years, I think, yeah. Okay, so if there are any hard copy past papers that we can use, great. If not, we'll use the ones that I've got. Okay. All right. And then if you do need any assistance after the 7 weeks or 10 weeks, it's available. So the telephonic, Skype, WhatsApp, leave a question. So if you have a question, just email it to me. All right, I'll respond when I can, and I'll give you feedback regarding the question that you've submitted. Okay, or if you feel like you want to discuss something telephonically, I can do Skype, I can do WhatsApp. It's totally up to you. Okay, but that's available should you require it. So we've got the time that's allocated for the course that we need to obviously get to the material, and anything additional, right, you can either use Skype or WhatsApp to receive support. Okay, those are the contact details, and then we've obviously got a little bit about the course. Okay, so UNISA has sent you that study guide, which looks like this. Okay, I did mention in the email that I sent you that the study guide has improved substantially in terms of additional information. So they've given you more background in terms of, I think there were videos I saw that was additional support. There were some audio things as well, and there were one or two PowerPoint presentations. Yeah, so they've definitely improved the support from a UNISA point of view for students, right, in terms of the content that's covered in the textbook. Okay, this textbook is brilliant. Okay, all the examples that you need to know in terms of workings are here, and unlike your other investment management modules, you had to buy 2 books. This book is just questions and answers, right? You'll see they give you solutions as well to a lot of the multiple choice. There's a few calculations as well, good examples, and the theory is really, really quite comprehensive. Okay, so the textbook is definitely something to keep for future reference. Okay, coming back to the slides, you do need to try work consistently, so try keep up week by week. It makes your studying a bit easier as well. And then the textbook that obviously is prescribed is that one, okay, 2003 Analysis of Derivatives. Financial calculator you've got, so that's great. And obviously the assignments we need to look at before your exam. Okay. All right, you've seen this slide before from previous modules. Okay, if you can, try pre-read the chapters, make notes on the slides that I've provided, and if you have any questions, feel free to ask anytime. Okay, so to start off, just to give you some scope in terms of the course, there's 5 study units that cover different derivatives. Okay, so today we're looking at the introduction in terms of what is an actual derivative. Okay, how does a derivative help with investment management? Okay, how does it act as a tool that we can use to manage risk? Okay, that's the biggest application in terms of derivatives, is the risk management. Okay, so study unit 1 is looking at the market, okay, looking at different instruments. Then we take it further, we look at each instrument in more detail. So study unit 2 is looking at forward contracts. Okay, study unit 3 is looking at futures. Okay, the one is over the counter, the one is exchange traded. And then we're looking at study unit 4, which is the options, right? So a lot of that you'll see is theory that you've covered in 2601, that was covered in, because remember 2601, it was 16 chapters of small bits and pieces from everything investments. Okay, then obviously third year they've split it into separate modules. So you've done bonds, you've done equity, and now you're doing the derivatives. Okay, I know UNISA, I think in terms of 4th year, I've seen portfolio management INV courses, right? I haven't hosted any classes for them, but I've seen those modules online, and from what I can tell is they've taken those portfolio management topics in 2601, and they've obviously expanded on it. Okay, so 2601 is almost like the bare basics, and all the 3rd year subjects take each of those and expand a lot more on them. Okay, so for example, we haven't looked at forwards and futures at all. Okay, we've spoken a little bit about what an exchange is and how markets are operating, okay, from an investment point of view, but we haven't looked at it in any detail. This module does. Options we have looked at before, but in terms of theory, they haven't looked too much at the strategy and the statistics. So there is a bit more stats that comes in to this particular module in terms of probability. So if one event happens or another, how does that affect your price, or how does that affect value? Right, and then the last is the swaps. Okay, and we've looked at swaps from a risk management point of view. So you've done risk 2601, right? I remember, I think, hosting class, and you were in that class where it was the old module where you did have to cover swaps, and then they've obviously changed it. Okay, so the swaps will cover here. It might overlap slightly with information that you've covered before in risk management. Okay, all right, just a bit about the objectives. Obviously, we need to look at derivatives. Okay, that's the main focus, and pricing is key. So we need to determine price and value of these instruments. Okay, like any other asset class, a derivative is a potential investment. Okay, it has value, but its value gets derived from something underlying. Okay, so we need to determine how do we value a derivative, i.e., something that derives value from something else. Okay, that's the biggest challenge. Okay, valuing those instruments. All right, so to start off, I've got 2 questions here I want you to consider. Can you recall one of the most important investment considerations?
Risk versus reward.
Okay, and?
I would say wealth maximization, but I think that's...
Okay, wealth maximization is the finance, which is fine. Remember, from an investment point of view, it's profit. It's trying to reap more reward compared to what we currently have in terms of capital. So taking capital, investing it, and reaping a benefit. Okay, so risk and reward is definitely something to consider. And what else? In terms of most important investment considerations. So risk and reward is definitely one of the top.
Most important. I want to keep on saying risk management.
Yeah, risk and reward, and something else.
Something else. I'm missing.
Timing. Okay, so what is your time frame in terms of period or duration? Okay, so how long are we going to be investing for? What time frame are we looking at in terms of T0, T1, T2, T end? Okay, because that's an important consideration. Okay, and when looking at markets are volatile. So over time, prices change. So now how do we reduce the effects of time affecting price? Okay, so we could enter into contracts where we could fix certain prices today, and depending on what happens in the market, we'll either benefit, okay, if it goes in our favor, or that option or that contract would be worthless if it doesn't. All right, so it's something to consider in terms of strategy, okay, because strategy obviously needs to be implemented in the market. Okay, and there's an element of time there. Okay, you can never ever time the market. Okay, the market is unpredictable. No one knows what's going to happen. Okay, but you'll formulate a strategy and you'll implement that strategy over a period of time. Okay, so you started with a bit of an introduction. You mentioned how tough it is currently in the farming industry in terms of agriculture and omnia. Okay, so in agriculture, right, the yield in terms of crops aren't going to be as high as they were in prior years because we've had a massive drought. Okay, so if farmers had foreseen a drought arising in South Africa, they could have potentially have locked in certain prices, okay, ahead of time, all right, before the actual drought had occurred, or they might have entered into contracts where they could have sold crop that's going to arise in the future today. Right, so time is the biggest consideration in terms of a derivative because we're looking at strategy. Okay, so how do we act today based on what we think will happen in the future? All right, so it's like taking a position today, but not putting all the eggs into that particular basket. Okay, so you want to invest in that particular asset, but there's a big question mark about what will happen in the future. Right, and the question mark relates to time. Okay, because no one knows what's going to happen tomorrow. Okay, we could have another terrorist attack. There's been a lot happening recently in Europe. Okay, the most recent one that I recall is the truck that was that literally rammed through a crowd of people in, I think it was Nice or somewhere in Paris or France. Okay, so that creates a problem from an investment point of view because things like that will affect the market. Okay, what is the investment goal though? Yes, okay, so from an investment point of view, it's return on investment. Okay, so what are we going to receive as a benefit from having invested? Okay, it's maximizing that capital. It's trying to get that capital growing as much as possible. Okay, and capital needs to be managed. Okay, capital can be easy or difficult to come by. Okay, so investment managers need to be responsible with capital because capital is actually part of the owners, okay, in terms of shareholders. Right, so you might be an investment manager managing funds on behalf of your clients. Right, you have to act ethically and you need to manage risk as much as possible. Right, because it's not yours, it's theirs. Okay, so there's a fiduciary duty to make sure you are investing responsibly. Okay, so every investment needs to carry certain, let's say, requirements. Okay, you can't invest anywhere. Okay, you can't invest in a company because you like the company. You need to invest in the company because of X, Y, and Z. Okay, you need to have all of the information in place to make that decision. All right, so the goal is definitely a return. All right, so what are the four main asset classes? They're here.
Stocks, bonds,
Yeah, stocks, so that's equity.
bonds,
Bonds, okay, so that's this one here.
property,
Yes.
cash.
And cash, correct. Okay, so those are the four main asset classes. Okay, are these the only asset classes that portfolio managers can use? No. Okay, so what other asset classes do you get? Okay, so commodities, gold, silver, copper, iron, etc. Yeah, commodities, so currency. So let's maybe, okay, let me rather type this as a bit neater. Okay, so currency, commodities, so currency, commodities, what else? Okay, so you could use derivatives as an option, so interest rates, derivatives, okay, so rates, swaps, futures, etc. Yeah, we'll look at some of those as we go. What else? What other asset classes? Artwork. Okay, art. Precious metals. There's a lot of companies looking at unusual. So it's more exotic in terms of it's not your gold, iron, copper, silver. Those are so commodities are more heavily traded instruments. So like soya beans, coffee, sugar. All right. Precious metals. Those are those exotic elements. Okay, those elements that are on the periodic table that are very, very unique to certain industries. Okay. For example, I forget the name of I think it's iridium or something like that, but it's something that's used in cell phones, okay, mobile devices, right? There's a specific element, okay, that's very, very valuable in terms of high demand and very low supply, right? That's used in certain devices, okay, electronic devices, and that's why a lot of electronic devices can be recycled, right? Because that metal, that specific element, okay, ingredient that goes into making a smartphone can be utilized, okay, in other places. So old cell phones that have the material can obviously be recycled, and that's why normally companies often ask for those old headsets, right? Because of the value in terms of metals that the particular device has. Okay, what else?
I suppose anything, really.
So the more exotic could be something like stamps.
Yes,
Okay, vintage cars.
yeah.
All right, almost everything, antiques. Okay, so in terms of investments, okay, what are we considering? We're considering diversification because diversification helps with managing risk. Okay, so we don't only look at the four asset classes because there are lots of other asset classes that we can consider. And if we do consider other asset classes, that adds diversification. So we're not investing in one asset because one asset will behave very differently in certain types of market conditions. Okay, if we've invested widely, okay, bonds might perform well in 1 year, in another it might perform quite badly. Okay, so since having completed your bond module, what has happened in South Africa and in the US? Correct. Yeah, the rates had gone up. Okay, there was lots of speculation about rates rising, and the first hike in America was in December. Okay, and then in South Africa, obviously, because of our bad unemployment numbers and high inflation, right, rates have obviously gone up a lot more in our country than in other parts of the world. Okay, all right, so that's a note about asset classes. Let's have a look at a derivative. So chapter 1 is defining this derivative, okay, in terms of an asset, okay, and it's also defining the market. So what do you require in order to have a derivative market, a functioning derivative market? Okay, so for example, primary and secondary markets, okay, primary market is what?
First time selling.
Correct. First time when you list on an exchange. Okay, so who would be the role players that will be involved in that process?
The company itself listing.
Yes.
JSE, obviously.
Yes.
First set of buyers.
Which would be the banks, yeah. All right, so corporate banks, okay, big corporate banks, and the, let's say, the companies, okay, the individuals trying to issue those shares or bonds, okay, would be the two main role players in establishing the primary market. Okay, once those instruments have been issued, what do those banks then do? Okay, resell. All right, so those instruments are then sold to third parties, and those third parties could be asset managers, they could be pension funds, they could be normal citizens, everyday people, other companies, it doesn't matter, government. All right, but the secondary market is where we would buy and sell those assets. Okay, so when looking at a derivative, okay, there needs to be a market for those products as well. Right, so if an investment bank has issued shares for a listed company, that company's shares would now be traded on the secondary market, which is, in our case, the JSE. Right, why do people buy shares on the JSE?
Guarantee.
Okay, safeguard, good, yes. All right, so there's the key word. Right, the JSE acts as a, let's say, conduit for people to enter into transactions that will be met. Okay, so a transaction that is concluded is going to be executed, okay, carried out. Right, there's no doubt that the JSE is going to settle that transaction. Okay, so you'll receive the shares, they'll pay out the funds to that particular company or investor, depending on the situation. Okay, so when looking at a derivative, a market also needs to exist for those products. And if you look at the word derivative, there's the word derive, okay, that's part of it. Okay, so derive. If something derives value, okay, what does that mean?
It's its value from the
Correct. Okay, so a derivative is actually a made-up product. And there's lots and lots of different types of derivatives. Okay, they're made up products. They're made up products because there's a demand in the market for certain, okay, products. Right, so if you want to lock in your interest rate for a certain period of time, because you want to do that, if there's a willing buyer of that product, that creates a contract, that creates a derivative. Okay, so a derivative in itself doesn't have any value. Derivatives are actually, inverted commas, in terms of true value, they're actually valueless. Right, what gives them value is the underlying asset. Right, the underlying commodity, the underlying bond, the underlying indice, the underlying anything. Okay, so did you do, I can't remember, you've done such a lot of courses with me. Have you done Risk 3701 with me? Okay, so do you remember we spoke about Berkshire Hathaway and how reinsurers can have insurers? All right, so right at the end of that module, we also spoke about weather derivatives. So you could even create contracts for weather. All right, so in certain industries, all right, or maybe events, okay, the weather might be an important factor that can play in that particular event. Okay, so you could then create a product for the weather derivative. Right, there's very exotic derivatives that can be created. As long as there's the market, as long as the willing buyer and seller, a bank would be willing to write that contract or to create that product. Because for the bank, it makes sense to sell more products. And what does the bank actually take? Does the bank take on the risk of that contract? Yeah, in most cases they don't. Correct, because banks act as intermediaries, right? So for them, they pass that risk on to someone else, right? So banks are there purely, okay, as transaction facilitators. Okay, they're there to make a market for certain products. So if you're looking at raising capital for a specific, let's say, company or project, right? The banks would help do that. Okay, so funding. So if you're looking at raising capital for a new venture, right? Banks can assist with raising capital for that item, so long as they can see the benefits and they know that there's a potential buyer for those assets. Okay, right. So the investment management textbook defines a derivative as a collective group of financial instruments. Okay, and there's a big group. We'll look at all of those as we go through the course. Okay, and the biggest thing that they talk about is this: deriving, okay, value from the underlying assets. Okay, so because bonds have value, because currencies have value, because shares have value, because indices have value, and commodities, gold, etc., have value, right, we can create contracts for any one of those items. Okay, so that's a derivative. So derivatives are contracts. That's the biggest thing. Okay, a derivative is a contract. It's a promise to pay, it's a promise to deliver, it's a promise to do something. Okay, it's a promise to get an interest rate, it's a promise to get a price for a certain commodity. That's all it is, it's just a contract. Okay, so with contracts, what are the pros and cons to a contract?
You're bound by a contract.
Are you bound by a contract?
Depends the type of contract.
Okay, certain parties in a contract can what? Cannot meet the obligation.
Yeah.
And does that create a problem?
Yes.
Of course it does. Okay, and that's why the derivatives, okay, need to be regulated more so than any other commodity. Okay, and why is that? Well, it's someone's promise to do something. Okay, so I'm willing to pay you something today for your future crop. Okay, so when you yield a massive crop in December, January, whenever the crops yield or mature, okay, I want that maize, okay, or I want that soybeans, okay, and because it's a promise, right, if something goes wrong in the market, someone is going to be out of pocket, okay, and most of these financial instruments, forwards, futures, options, and swaps, have a win-lose situation, okay, there is a unique derivative that offers a win-win situation, okay, but we'll look at that a bit later. Okay, we might even have discussed it in one of the other modules, okay, but we'll cover it again in case you missed it, okay. Right, so a contract is a legal binding document. Okay, we know law is something that can be very problematic because law is up to interpretation, okay, and if someone says they're going to do something, right, hopefully it would be done in good faith, right? So contracts should be concluded in good faith, right? I.e., if you say you're going to buy my crop in the future, whether the crop is a lot or little, okay, it shouldn't affect our contract that we entered into 10 years ago or a year ago or a month ago, depending on how long the contract is valid for. Okay, so a derivative is looking at creating contracts based on other items. Okay, so institutions can create assets. We just spoke about that, okay, which will have value depending on the underlying assets. Okay, so how could this tool be used in portfolio management? Okay, so risk management, okay, is what? What is risk management? Define risk management.
Increasing your exposure to risk or keeping it the same.
Okay.
Increasing your risk if you want it.
Yes, okay, so risk management is looking at, well, there's a process. So risk management obviously starts with, okay, let's just put that word up, risk management, okay, looks at the identification. So step number one would be to identify the risk. Okay, once you've identified the risk, then you would have to evaluate the extent to which that risk would affect your business, okay, or company. Right, so step one is to identify, step two is to evaluate. Right, then there's an element of risk control, okay, risk control, and then risk financing, and then ultimately the monitoring, risk monitoring. Okay, so that's the risk management process. Okay, that's defined by the risk management, what do they call it? INV, Risk Management of South Africa, International Risk Management of South Africa. Okay, so when looking at risk management, there's a process that we need to go through. Okay, and we're looking at derivatives. So as a tool, how do derivatives help with managing risk? Is it the identification, the evaluation, the control, or the financing, or the monitoring?
Control and financing.
Okay, the control would be non-monetary ways of implementing process or improving process to avoid
risk. But that wasn't that just
to mitigate risk. Yeah, so for example, changing your password every 30 days. All right, you're reducing the risk of unlawful access to information, okay? And that doesn't cost anything. Right, risk financing is where we're using money to solve problems. Okay, and that's where derivatives come into it. Okay, so how can this tool be used in portfolio management? It's the risk financing in terms of managing risk. Right, so we know we need to manage risk as much as possible because we can, to some degree, reduce it. Okay, we don't know what the outcome is going to be in terms of a reward. Okay, so when looking at a tool for risk management, okay, it's a product that can be utilized, okay, for speculative purposes. Okay, so you might have let's say, a view on the market, and you should always have a view on the market. Right, the market, in terms of news, in terms of information, in terms of consensus, will have a view. Right, and it's your role as the portfolio manager to try understand or at least interpret the current view in the market. Okay, if you have a view on the market, so for example, you're not going to be wanting to, let's say, take out more debt in the current scenario purely because rates are more likely to go up than they are to come down. Right, if it was the other way around, you'd be more inclined to take out debts if the rates were seen to be falling rather than rising. Okay, so when looking at a product, okay, this particular product helps us to speculate. Okay, so for speculative purposes, those derivatives are useful. Okay, so a portfolio manager could potentially yield even greater returns, and that's how managers, okay, achieve alpha returns which are above average market returns. Okay, above average market, I'm just going to say above the markets. Okay, above average market returns. Okay, so the only reason why certain asset managers are better than others is because they have freedom to speculate. Okay, and that's why active portfolio managers generally charge an additional fee for their service because they're actively buying and selling certain instruments, right, to try yield above average market performance. Okay, whether they get that right or wrong is another story, and whether the fee is justified or not is another story. Okay, we're just looking at how can we use this to try yield above average market return. Sometimes they get it right, sometimes they get it wrong, but it's there to be used as part of portfolio management. Okay, so alpha is achieved only because we speculate. Okay, if you're not speculating, right, you're never ever going to outperform the market. You might as well just invest in the market because then you'll be getting the index. Okay, so if you invest according to the top 40, you're going to be getting the return for the top 40. Right, there's no active investment management there. Okay, it's I'm happy with what the market gives. Right, but derivatives can help you yield more. Okay, and it also adds an additional amount of leverage. Okay, leverage is something that we'll look at in terms of returns. Okay, that can be used for certain instruments. Okay, that's alpha and that's leverage. Okay, so derivatives are also used to help position yourself in the market, which adds leverage. You could have exposure to a much bigger position by utilizing derivatives than you would if you had to invest in those actual assets. Okay. Alright, so the H word, I think I already revealed it, so you probably saw it.
Hedging.
Hedging. Okay. That's the main reason why we have derivatives. Okay, so all what we spoke about there is relating to that. Okay, hedging is a way to take a position where if things go bad or if things go good, there's still going to be some sort of profit, inverted commas. Okay, so hedging is a way to reduce risk by taking almost like an opposite position to what you currently have. Okay, so you believe the market's going to rise. Okay, it's like taking out insurance in case the market's going to fall. Right, so you might take an option to sell the market, but your position is actually long. Okay, so you want the market to rise, but let's take out some insurance because should the market fall, we'll still profit. Okay, but we're still in the market, so we're still holding those shares, but our derivative is going to be worth more if the market collapses. Okay, that's a way to try create a return in any scenario because you're still holding those shares, you're still holding those assets, but this derivative can now benefit you in terms of generating additional return from those underlying assets. Okay, so it's like so for example, you've got a textbook. Okay, you're using the textbook, so it's giving you value. Okay, if you knew someone else who was also studying the same module, okay, you could maybe rent or borrow the textbook and that would even reap more benefit. But you're going to have to sign a contract with that individual. You're going to have to say, well, this is my textbook, okay, so if you require it, we'll loan it to you, but you're going to have to pay a fee. Okay, so now you've got a contract for your textbook, but the asset is still yours. Okay, that's what a derivative is basically. Okay. Alright, so that's the scope in terms of what this particular module actually entails. Coming back to your slides, you've got study unit 1. Okay, this is looking at the theory. Okay, so we're looking at the structure. How are these markets structured? Okay, where are the biggest derivative markets in the world? Okay, that's what we're looking at here. Okay, so argue the concept of derivative. Okay, this is all theory, right? I don't think they'll test too much of this from a test point of view. They'll probably test you in terms of multiple choice, lots and lots of short questions. Okay, but you're not really going to see a long question from this particular module. Okay, unless they want you to write an essay, it's not a very easy chapter to test. Okay, from an examiner's point of view. Okay, right. We need to differentiate between exchange traded and over the counter. Right, we should have an idea roughly what that is. Okay, the main thing is regulation. Okay, we'll look at what a forward is. Okay, we'll look at the difference between a forward and a future. Okay, and how those are considered contracts. Okay, and what effect, okay, can occur in terms of contracts, let's say, defaulting. Right, so can a contract default? Yes. One party can say, well, that position is just too onerous to meet. Okay, there's no way I'm going to deliver gold at $800 an ounce. Okay, that's not something that's possible. For them, it's going to put them out of business. For someone else, it's a massive profit. Okay. Right, we'll also talk about contingent claims. Okay, if something is contingent, what does that mean?
If something happens, or might happen.
Correct, yeah. So in accounting, they talk about like contingent liabilities and all of those things. Okay, so contingent means there needs to be some sort of event that triggers something else. Okay, so contingent claims, okay, would be claims that could arise from something having occurred. Okay. We'll also look at distinguishing between buy and sell options. Okay. We'll measure the size of the global derivatives market. That's nice to know. It's something quite interesting. Okay. And we'll also look at criticisms for that particular market. Okay. And we've obviously heard of Lehman Brothers and the crisis and credit default swaps. Okay. Lots and lots of criticism for this particular market, but also lots and lots of praise for this particular market. Okay, because ask a farmer who's locked in a really nice price for his crop, and down the line, price drops because there's a huge flood and there's crop everywhere. Okay, there's an oversupply of maize. Right? For him, he's going to have to reduce his price, but he's locked in a higher price prior to the huge yield, and that's going to benefit him. Okay, so there's praise and criticism. There'll always be praise and criticism. Okay, Interpreting the concept of arbitrage. Okay, we've looked at this concept before. We'll look at it again here. All right, so earlier you spoke about risk and reward. What is the relationship between risk and reward?
Increasing risk, increasing potential reward.
Okay, so that's the basic principle from a CAP-M point of view in terms of this. Linear relationship, risk and reward. Okay, from a derivative point of view, from an asset management point of view, from an investment point of view, what should our view be in terms of risk and reward?
Decrease the risk, but then decrease the reward.
No.
Or maintain your risk.
Okay, I'm going to turn this concept on its head
Yeah.
because when looking at risk and reward, theory says if I take on more risk, I should get a bigger reward. But what's stopping you from taking a risk and maximizing the reward? Okay, so keeping risk at a specific level, but not allowing the reward to be limited in any way. Okay, so what I'm trying to say is risk can be contained,
Without containing the reward.
okay, without putting a cap on the reward. Exactly. Okay, so you can contain the risk, okay, but let the reward, okay, realize itself.
Yeah.
Okay, so when looking at strategy, okay, risk is what you stand to lose. So it's like your stop loss, okay, or it's what you're comfortable losing, what you're comfortable losing. Okay, and that particular concept has a very interesting, let's say, what's the right word? Impact, okay, on your decision making. Okay, so if you're the type of person who's comfortable losing, right, there's nothing wrong with being a loser. Okay, society says losing is negative. All right, but ask any successful person how many times they've failed.
More than
Right.
necessity.
And they'll probably tell you exactly that. So you're probably a successful person because you've got that life experience. Okay, you've mentioned that. You have to fail your way to success, basically. Right, so what do we need to look at here in terms of risk? Risk is what are you prepared to lose? Okay, in terms of capital. All right, so if I'm looking at capital, okay, am I prepared to lose 1% of my capital? Am I prepared to lose 10% of my capital? Okay, that's something that you need to determine from a risk management point of view because you need to manage that capital as much as possible. Right, because can you invest if you don't have capital? No. So you need to protect this capital as much as possible. All right, so you can say, well, I'm willing to take a risk. I don't really care what the reward is, but I'm comfortable with a 1% risk exposure. Right, so of my capital, okay, I'm prepared to risk 1% of it. Okay, whether I win or lose makes no difference. Okay, if the market goes up, great. If the market goes down, great. I don't care what happens in the market. So long as if things go bad, I only ever lose 1%. Right, so if you're managing a portfolio of funds for clients, okay, can your client live with a 1% loss?
You'd have to ask them.
You'd have to discuss that with your client. Is your client comfortable with a 10% drawdown? Again, it's something that the client would be willing to say yes or no. Okay, so that's the risk in terms of containment. We're containing the risk. We're saying, well, we'll happily put 1% in the market. Whatever happens, happens. Okay. If things go great, great. If things go bad, great. Okay, so the point I'm trying to make here is when you look at risk and reward, is there any emotion in risk and reward? There shouldn't be because you've actually made the decision ahead of time, and that's the strategy. Okay, so you're implementing a strategy based on things that are definite. Okay, so basically people only get emotional, okay, is when they're actually in the moment. Okay, so when you're watching the market, right, you're in the moment, now things get hectic. But if you know what you wanted going into the market and you knew what rules you had in place in the market, so I know what I'm looking for, okay, and that's what I'm going to do when the opportunity presents itself. Okay, so when looking at risk and reward, we're looking at that containment of risk. Okay, that opportunity to invest without putting the whole house on the market, basically. Okay, so what do investment managers have to do? They need to accept risk. There's no reward without risk. Okay, but risk can be contained in terms of a monetary amount or percentage. Okay, so how much of your portfolio are you willing to risk? Okay, rather than am I high risk or low risk? Okay, high risk, low risk, that's your risk tolerance. So if you're high risk, right, high risk, so for example, think about riding a roller coaster. Okay, if you watch the roller coaster, is the roller coaster exhilarating? Do you get any thrill from watching the roller coaster go up and down? No. But if you're actually sitting on the cart and you're going, right, it's a very different experience, right? So watching the market isn't, let's say, isn't it's not as real as being in the market. Okay, and that's why capital, okay, what is capital doing? Capital is basically watching the market. Okay, so you're watching and you're looking for opportunity. Okay, if opportunity arises, we put 1% in the market. If it continues, okay, we add another 1%. Okay, if the position's good, we add another 1%. Okay, but we're only exposing ourselves to 1% at a maximum. Okay, so obviously you've probably heard of rebalancing. Yes, no? Okay, rebalancing. All right, and index funds do that every day. Okay, because the market changes. All right, one asset might be worth more than another. Okay, and then they rebalance the fund. They sell some of those shares, they buy some of another. Right, and that's how an index fund basically operates. Okay, they rebalance the fund every day. Okay, so from an investment management point of view, investment managers need to accept risk and they need to build wealth. Okay, so if you're building wealth, you're going to take profit when profit arises. Okay, as long as you're only exposed to 1% of risk, you're never ever going to lose the other 99%. Okay, and that's risk management, and that's strategy. So strategy here might be a 1% exposure to risk, whatever it is. It can be derivatives, it can be anything else, but I'm only going to risk 1% of my capital in the market. Okay. Can you make a reward if you don't take any risk? No. Okay, and derivatives offer so much more opportunity. Okay, because now you've got access to instruments that have never ever existed. Okay, so it's almost like going to the supermarket where they've only got, I don't know, 10 brands of cereal, right? And now all of a sudden they've got 100 brands of cereal. Okay, it's like a kid in a candy store. There's so much opportunity. Okay, because with more variety comes more opportunity. Okay, because now instead of only buying, okay, gold, I can buy gold, fine. But now I can buy EFTs in gold, I can buy derivatives in gold, I can buy futures in gold, I can buy forwards in gold, I can buy whatever I like in gold, options in gold. Okay, it creates a better market. Okay, it creates a more efficient market because now there's more products in the market. Okay, so investors take risks to exploit profitable opportunities. It's all about opportunity. Okay, when opportunities arise, you need to grab it. Okay, do we take non-profitable risks? Of course not. Okay, risks need to have potential. Okay, so you're not going to be investing if there's no potential. Right, and that's the other side of things. So the first bit is let's contain our risk as much as possible. Okay, risk containment is how much of your capital are you willing to expose to whatever. Okay, the market in general, derivatives, etc. Okay, then the next bit is what sort of risks are we going to take? So now I'm prepared to risk 1%. Where am I prepared to risk it? Okay, are we going to put the 1% in the lotto? No. Okay, because the probability is against us. But ask that guy from Polokwane and he'll say something different.
Yes.
Okay.
Or also the guy that did the option, I think it was an option, I'm not too sure which derivative it was, on the pound.
Okay, I haven't heard that one. Yeah.
Millions overnight when they
Okay.
Brexit.
Yes. Okay, but
Lots of position.
yeah, but yeah, in terms of the lotto, that guy won like 87 million, and he bought that ticket at like a petrol station somewhere in Limpopo. Yeah.
It was some random
Yeah.
place.
Yeah, so very, very lucky. Okay, so there in terms of potential. Okay, so what was the potential? The potential was 87 million. Okay.
Yeah, the probability
He was
was
prepared.
like
Yeah, see, that's another thing. That's yeah. So when we look at potential, the lotto versus, let's say, equity. Okay. All right. In terms of probability, okay, in terms of potential, right, that's something to consider. So if you had to risk 1% of your capital buying lotto tickets, okay, is that potential adequate enough to justify the risk of 1% capital? Maybe, maybe not. It all depends. But if we look at the lottery in terms of what chance do you have in terms of yielding return? Okay, so what are the chances of getting all 5, 6, 7 numbers, however many? I don't play the lotto. I'm not a fan. Okay, but yeah. So if that's the case, what's your probability? Okay, what's the probability in terms of percentage chance of actually winning the lotto? I mean, yes, they can pay out 87 million, but it's probably because they've collected 800 million. All right. So in terms of potential, okay, equity, shares can either stay flat, shares can either go up, or shares can go down, and that's it. Okay. So when we look at options, they normally talk about they do like a tree. I don't know if you've gone through the material yet, but they talk about trees. So plus and minus, up or down.
Oh, just a
Okay.
probability.
Like a binomial type of, binomial, trinomial, those types of things. Okay, so binomial distribution, positive or negative depending on the situation.
And then there's a factor to move the bar.
Yes. Okay, and then you obviously you'll price it according to whether that happens or whether this happens. Okay, so I remember you mentioned the delta in, I think it was options. Okay, those deltas, thetas, omegas, and all those fancy Greek alphabets. Okay, why do they use the Greek alphabet? Because the Greeks created maths. Okay, algebra. All right, Pythagoras, Euclidean geometry, all of that stuff. Okay, so in terms of mathematics, maths come from the Greeks. Okay, the old Greeks and Romans. Okay, Greek alphabet, Roman alphabet, etc. Okay, and that's why to this day they still use the Greek letters for things like stats. Okay, alpha, omega, all of those things. So investment, they do the same thing. They use those terms to refer to certain changes. Okay, so what will happen to the change in price if the underlying asset had to change? Okay, so if the underlying asset had to increase, what will that do to my derivative, and that type of thing. Okay. All right. So the next bit. So we're aware of risk-reward relationships. Okay. Can we limit risk?
Yes and no.
Okay. Yes.
You can.
Yes.
Do you want to just manage risk? Doesn't matter.
Well, risk management would involve limiting it. Yeah. Okay, so if you want to refer to the risk management, that's also fine. So can we limit the risk? Of course we can. Okay, you can say, well, if I buy, okay, I'm going to talk about options because you're familiar with that. If I buy options, I'm only going to lose the premium. Okay, so it's speculative. All right, so whether I win or lose, I know what I'm going to lose. I'm going to lose my premium. The premium can be $1, the premium can be $100,000, it doesn't really matter, but the premium is what you stand to lose. Have you limited risk? Yes. You haven't limited risk in terms of market risk.
No.
All right, because you're buying an asset. Okay, you haven't reduced geographical risk. So if you're investing in another country, you haven't reduced currency risk if you're investing in other currencies. Okay, but you've limited the risk in terms of exposure. Okay, so capital. How much capital is exposed to the market? Right, so can we better manage risk? Yes, we can. Okay, so consider forwards, futures, options, and swaps, because what do? They allow you to speculate, and they allow you to manage risk. Okay, to say, well, I'm happy to take out a contract for X number of dollars or pounds, okay, or I'm happy to buy a future or forward, okay, for a particular commodity. Okay, so what do all of these have in common? Forwards, futures, options, swaps.
They're all been underlined.
Yes, and
They're all been, they can all be used to limit risk.
yes, and
They're cheaper.
no, you can't really say cheaper, because if things were cheap, then there'll always be an arbitrage opportunity.
But they are. What else do they have in common? As far as something very straightforward.
The answer's actually in one of the words.
Really?
Yeah. Future. They all pertain to the future.
Yes, true.
Okay, so all of them
Future.
relate to the future, and we know risk relates to uncertainties that can arise in the future. That's why there's risk. Risk exists purely because we want to know what's going to happen in the future. Can anyone predict what's going to happen in the future? No, but derivatives give you an indication of what will happen in the future. Someone will be willing to sell you a contract today that pertains to the future. Right, so if you ask someone to predict what is the price, so let me ask you, what is the price of oil going to be in the next 10 years, let's say?
I have no idea.
Yeah, but
Buy an option
you-
on swap or a future.
exactly, you could buy a future that would be willing to sell you oil in the next 10 years. That would be the current price in the next 10 years.
Which makes sense.
Okay, so that's what they have in common. Okay, they all pertain to the future, and they're all contracts. Okay, future contract, or current contracts that pertain to the future. I need to add that. Okay, so when looking at contracts, okay, we spoke about it earlier, so I don't need to touch on that again. But the main thing is time. Okay, so as much as we don't have a crystal ball, the closest thing we have to a crystal ball is a forward, a future, an option, a swap. Right, because those instruments tell you about what's going to happen in the future. Okay, and that's why, so we're living in South Africa. So the market in the US normally opens at around 2, 3, 1, depending on, okay, well, in terms of official opening, when the bell rings on the New York Stock Exchange, okay, that's normally 2 or 3 depending on daylight savings. Okay, but the market actually opens a lot earlier than that because people are speculating, okay, is the market going to open higher or lower? All right, and those are futures. Okay, so you get futures on indexes. Before the index even opens, the market already has an expectation on what's going to happen. Okay, and those are derivatives. Okay, so, and that's the crystal ball, right? So if futures are pointing towards a higher open on the US market, okay, all right, that would point to an increase in price for those particular assets on that particular market. Okay, so if you're already in a position and futures are pointing towards an increase, right, you'd probably stay in that position. You wouldn't want to close your position, okay, because there could possibly be more profit, okay, that could arise. Right, so that's something to consider in terms of contracts. Okay, there's 2 important definitions. We've actually discussed the first one, which is hedging. Right, what is hedging? There's a nice definition: protection against overexposure. All right, so what does it mean to be overexposed? Well, if I take a long position and I add to that position, I'm overexposed. If I take a long position but I take out a short, I'm lowering the exposure, because now you're effectively cancelling the one position with the other. Okay, and that's what hedging is. Hedging is protection. Okay, the best way I can relate that to something you're familiar with is insurance. Insurance, retaining the upside while limiting the downside. That's exactly what a hedge is. You're trying to maximize the up, but then also limit the down. Okay. Alright, so what does the market look like? This is a table or diagram just to show how and the different topics we'll cover over the course. Okay, so derivatives are broken up into two groups: forward commitments and contingent claims. Okay, those are the two areas. Okay, contingent claims we'll see a bit later. For now, let's focus on this: forward commitments. What is a forward commitment? Well, there's the keyword forward, future. Okay, so not now, but sometime in the next month, year, 2 years, 3 years, depending. Okay, so if I'm looking at those commitments, okay, have you ever, you probably have you ever met people say things and they don't do it?
Yes.
Okay, so why don't they do it?
Well, either one, they overanalyze.
Okay, besides that,
Two, they're nervous because they don't know
okay,
what's
there could be
gonna
nerves
happen.
and fear,
Yeah.
but it's because people don't do what they say because there's no commitment.
No.
Okay, so forward commitment. So do you think investors or people that offer the investments, is there any commitment, all right, in terms of what you say? So I'll tell you today. So for example, a bank could say, well, I will tell you what the price of gold is going to be in the next year. Okay, that's hearsay. That's just something that they've said. Okay, we need some commitment. So the bank needs to put something on paper to say, well, I believe that the price of gold is going to be X in the future. So what are they going to do?
They're going to commit something.
They need to create a commitment. And that's the contract that will be either exchange traded or over the counter. Okay, there's no point. So some people say things and they don't do it. Okay, it could be because of other factors: risk, nerves, fear, whatever. Okay, but in terms of, if I just relate it to the investment side of things, people don't commit. It's because of a lack of commitment. Okay, so there's no commitment. If you've committed to doing something, you're going to do it. Okay, there's commitment. Right, so when looking at exchange trade and over the counter, those are two examples, okay, or categories or groups of forward commitments. Okay, we'll discuss which is better. Right, we'll prefer those rather than those. Right, but those also provide opportunity. Okay, so why do we still have a market for over-the-counter derivatives? It's because people out there are always looking for opportunities. People are always looking for ways to receive a return. Okay, so in terms of a derivative, okay, derivatives provide opportunities. So I could look at exchange traded derivatives and I could also look at over-the-counter derivatives. Right, there might be exchange traded derivatives that I don't fancy. Okay, there might be certain contracts that just don't meet my requirements. I want to customize it. Okay, so for example, when someone goes to a car dealer, what does the car dealer do? They offer you all these options. Whether you take those options or not, it's totally up to you. Okay, but they give you that option because it's a way to customize your product or your service. Okay, so when looking at exchange traded, we've got futures. Okay, and forwards and swaps are over the counter. Okay, because there's no formal exchange to regulate or to manage those contracts. Okay, and that creates a slight problem.